Welcome back. In this video, we're going to... Welcome back. In this video, we will be discussing the last two steps of the accounting cycle, Step 6 and Step 7, and that will complete the loop for the accounting cycle. So let's start with Step 6. Step 6, put simply, is to prepare the financial statements. But it's not quite as simple as that. In order to prepare the financial statements, we will have to take all those adjusting entries that we just went over, and we're going to have to put them back into the general ledger. We will then have to repost to the general ledger and then create an adjusted trial balance, which will take into account all the adjusting entries for all of the active accounts. We then have to ensure that all the debits and credits equal each other on the adjusted trial balance. If they don't, we've got to go back and find where the error is. And then and only then can we prepare the final financial statements. Now, back in Chapter 2, when we looked at the extensive entries made to high-tech communications, we had left ourselves with this trial balance. Notice the balances on the accounts, and notice that the debits did equal the credits. Now, in this chapter 3, in the most recent video, in fact, we went through 7 adjusting entries. On top of the regular transaction entries, we had 7 adjusting entries. These were all the original balances for all of these accounts. But notice some of them, like accounts receivable, supplies, prepaid insurance, accumulated depreciation, we did adjusting entries to those, which means they ended up with new balances. With those new balances, we then run a new trial balance called the adjusted trial balance, and we hope, which is the case, that the debits in total equal the credits in total. I'd encourage you to go back through your Cornerstones textbook and prove out that all of that actually does happen. Now, if that had all worked, we would be ready to prepare the financial statements. The income statement would be prepared from all of the revenue and expense accounts. Net income at the bottom of the income statement would be used to prepare the retained earnings statement. And the balance sheet would be prepared from the ending retained earnings balance as well as all of the asset and liability accounts. Now, just to show you on the trial balance, all of these would be the balance sheet accounts and all of these would be the income statement accounts. If all of that worked out, we would be ready to close the accounts. Now, what does that mean? Well, we have to be careful to know the difference between permanent accounts and temporary accounts. The permanent accounts are all of the asset, liability, and stockholders' equity accounts. Notice those are all balance sheet accounts. These accounts all take their balances and carry them forward into future periods. Then we have temporary accounts. Basically, the income statement accounts are temporary accounts, revenues, expenses, dividends. These are all used to collect the activities of only one period, and then we need to close them out. You don't carry forward from one year into the next a revenue balance or an expense balance or a dividends balance. We need to get that back to zero before we're done with that particular financial period. So what we need to do is we need to transfer the effects of the temporary accounts into retained earnings, which is a permanent account. That means we clear that particular temporary account down to a zero balance. If we did not close those temporary accounts, we would be accumulating the activities of all periods. That would be bad. We would be overcounting revenues and expenses from year to year. Okay, so how do we close the revenue accounts? We close them to something called the income summary account. Remember, revenues are collected as credit entries. So in order to clear a credit balance, we have to enter a debit entry. So we would debit revenues and we would credit the income summary account. In order to close expenses, remember expenses are always recorded as debit entries. So to clear a debit balance, we would have to enter a credit to expenses, and then we would debit the income summary account. Then we take the balance in that income summary account. That is our net income. The total debits and credits would give us the net income. Then we have to close that income summary, whatever the total balance in it is. We close that to retained earnings. If the net income was greater than zero, if it was positive, then we would be debiting the income summary and we would be crediting retained earnings. Now that would be a good thing, right? We want to credit retained earnings because that means we're increasing retained earnings. However, if the net income was negative, it would be the opposite. And finally, the last thing we need to do is close the dividends account because we pay dividends potentially a few times a year, but we don't want to roll those balances forward. So in order to close the dividends account, we would need to credit dividends and debit retained earnings. So let's follow Cornerstone 3.7 in your textbook, and let's follow how we would close these accounts. We're back to Porter Properties, the company that rents properties, and their general ledger shows balances as follows. There's a rent revenue balance of $2,174,000. They had salaries expense of $1.3 million, supplies expense of $150,000, interest expense of $15,000, insurance expense of $20,000, a beginning retained earnings balance of $1,135,000, and dividends in 2011 of $5,000. First off, let's close the revenues. We're going to close them to the income summary account. Well, we would pick our date as December 31st because it's the end of the year. In order to close a revenue account, if I've been accumulating revenues as credit entries, the only way to close it is to close it with a debit entry. So I would debit the rent revenue account and I would credit the income summary account for the exact amount of rent revenues totaled throughout the year. Next, I need to close all the expenses. Well, there's quite a few expenses here, right? We've got salaries expense of $1.3 million, supplies expense of $150,000, interest expense of $15,000, and insurance expense of $20,000. Expenses would have been entered as debit entries throughout the year. So in order to close this account, I'm going to have credit entries to each of those expense accounts. And notice, a credit entry for each one of the expense accounts, and then I debit income summary. And this is all as of the end of the year. That's when we close the accounts. So if this is where we had ended with the total expenses and previously the total revenues, now we need to close that income summary account. Well, we had made a credit entry of $2,174,000 to the income summary account to deal with the revenues, closing out the revenues, and we had made a debit entry of $1,485,000. There we go. That means there was a higher credit amount. If I subtract the debit from the credit, I come up with a credit balance of $689,000 in the income summary account. I now need to close the income summary account. If it has a credit balance, I'm going to have to close it with a debit entry, right? So I'll take a debit of $689,000 and I'm going to put a credit entry in of $689,000 to retained earnings. And remember, a credit entry to retained earnings is an increase in retained earnings, which means I ended up having positive net income to add to my retained earnings as Porter Properties. Last step, I've got to close the dividends account. According to the information in our problem, Porter Properties had $5,000 of dividends. Remember, dividends decrease retained earnings. Dividends are usually entered as a debit entry. So if I'm going to close out a dividend account that would have probably had a debit balance, if there had been dividends throughout the year, I've got to close it with a credit entry. Got a $5,000 credit amount to the dividends account. That closes that out. I have to close it out to the retained earnings account, so I put a debit to retained earnings of $5,000. This is all as of the end of the year. Remember, a debit to retained earnings will decrease retained earnings, and that's how I close the dividends account. That would be the entire closing process for Porter Properties. Now let's just look at what would have happened. In the first step, we closed the revenues. Remember, in the revenue account, there was a credit balance of over $2 million. I close it out by making a debit entry. The other side of that entry, follow this arrow right here, the other side of that entry was a credit amount entered into the income summary account. In step 2, we closed the expenses. All the expense accounts for Porter Properties had a debit balance of $1,485,000. So in order to close it, I had to make a credit entry. And the offsetting entry was a debit to income summary. At that point, we had debits of this amount, credits of that amount. That left us with a credit balance of $689,000 in income summary. And the third step was to close income summary. The way to do that in this case was to enter a debit of $689,000. The other part of that, follow it down here, was a credit entry to retained earnings of the same amount. Lastly, step 4 was to close the dividends account. There had been $5,000 of dividends, which would have been a debit balance in the dividends account. We closed the dividends account by making a $5,000 credit entry. The offset to that is a $5,000 debit entry to retained earnings. And that is how we close the books for a company. This concludes our videos for Chapter 3.